Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. Is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Steve Saretsky, Vancouver-based realtor, online at SteveSaretsky.com. Welcome back to the show, Steve.
Always a pleasure. Thanks for having me on.
Steve, how are March sales looking for real estate?
Yeah, we didn't have the spring bounce, I guess, that most anticipated. Obviously, we still have a couple more months of this busy spring selling season, but we know that January, February got off to very, very slow starts. And, as is typical in housing markets, once the trend is in place, they tend to continue for much longer than people would anticipate, and that seems to be the case here in March. So, preliminarily looking at the numbers, to end March here, Greater Vancouver as a whole, across the lower mainland, if you're looking at all property types, so whether that's detached, condos, townhouses, you throw those all in a bag, you'll get a sales number that came in at the lowest total for the month of March since 1986. So we had a 33-year low in home sales for the month of March across Greater Vancouver. If you break that down further, I mean, most of the weakness, so I wouldn't say most, but a huge chunk of that weakness is still in the detached single-family market. That's, as far as I can see, reached near record lows. But we also had an 18-year low in condo sales. And obviously that's been the one segment that everyone's been talking about, suggesting that it might hold up or continue to be strong. But I think that is clearly being debunked here.
As sales continue to slow, are dropping prices likely to pick up speed?
Yeah, I think that's beginning to what we're seeing. I think, the biggest issue is in real estate markets. There's a lot less transparency and there's a lot more emotions attached. So it generally takes a really long time for prices to come down. They can be tremendously sticky, as we've seen here. Sales volumes ultimately peaked, particularly in the detached housing market in 2016. And it's really only been over the last 12 months that you've noticed a significant drop in detached home prices. We're starting to see the condos follow suit. Obviously, it's easier to track condo prices because, each unit in the building is pretty much the exact same. So as soon as a new benchmark in a building is set, it tends to sort of set the precedent for the rest of the units in a particular building. So, but yeah, I would say long story short is, I think from here, I don't know how much lower the sales volumes can get. To have a 33-year low in sales when, your population growth since 1986 and your housing stock supply has grown exponentially since that time. So I think sales have likely bottomed or will come close to bottoming here this year. And it's just a matter of, in order to get the volumes to pick up, you'll have to see lower prices.
Right. I mean, we have anywhere from 23,000 to 50,000 people a year move into Greater Vancouver. Where are they going to live if they're not buying someplace or renting?
Yeah, exactly. So I think, I tend to find that, at least if you go and study previous housing booms and busts, is that generally there's always seems to be a housing shortage during the boom years as speculators and investors pick up units, and obviously as prices continue to rise by double digits each year, there's less of an incentive to rent out a unit. But what we're seeing is not only with falling home prices and increased taxation on vacant homes, is that it's forcing a lot more units onto the market. And so that's why we're starting to see some easing up in vacancy rates, as well as in rent prices. Rent price growth for condos has been flat for about a year now, and you're actually seeing declines in the single-family housing market. So that's starting to ease up, and of course, migration flows also fluctuate with the strength of the economy. And I suspect when home sales grind to a 33-year low, that eventually that's going to have some knock-on effects on the labor market as well.
Now, of course, we've heard contractors aren't building as many homes right now because they're worried they won't be able to sell them. Is that going to create a housing shortage in the near future?
Yeah, I mean, these things are always cyclical. So what happens is obviously, developers build when they can get access to money, and when it makes sense to take the risk, if it's worth the squeeze to take on that kind of risk. And so, obviously what we saw was a record number of housing starts in the last couple of years, primarily because it was profitable and because banks were, eager to lend money to real estate developers. Actually, loan to developers recently hit an all-time high across the nation. But as banks will basically determine, not necessarily developers, it's actually banks that generally determine when developers get to build. And what we're seeing now is the banks are tightening up, and that's curbing some of the future housing supply. So I think as the cycle plays out, yes, you'll likely see sales pick up, prices fall. That'll lead to a drop in housing starts and new construction. And eventually, over time, the cycle restarts where there'll be, again, a shortage of supply. Developers will begin to build again, and prices will begin to recover.
We'll have more with Steve Saretsky right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Steve Saretsky. Steve, what is the inverted yield curve, and what could it mean for real estate and the economy in the lower mainland of British Columbia?
Yeah, so, I mean, obviously that's been a pretty popular search these days. A lot of questions on that. It's essentially just really all it is just an indicator of sort of what the bond market or what market participants essentially think of where the economy is heading. So essentially, they're projecting basically future lower growth in the long term, and then obviously the central banks are going to have to essentially cut rates in the short term. So basically what it does is the inverted yield curve is generally a leading indicator that a recession is on the horizon. That's pretty much what it is. It's every time the yield curve is inverted, you've almost always had a recession. So that's really how it looks. From as to why that might cause a recession, I mean, there certainly are different views on that. But I think one of the primary ones is essentially that banks it's basically a signal or an indicator of, credit tightness. And basically what happens is banks, begin to tighten credit, particularly as, short-term interest rates rise through central banks hiking interest rates. So short-term, loans begin to contract. Certainly what we're seeing in Canada. And, banks also perceive that the economy is starting to slow down. And so that just basically disincentivizes them, along with compressed net interest margins, i.e. it becomes less profitable to issue loans, due to the flat or inverted yield curve. That basically just curbs, lending even further. So obviously what the real estate market needs, in order to gain a recovery is they need loan growth to pick up, not to slow down. And unfortunately, generally a yield curve compression just discourages bank lending even further, particularly as the housing market, banks start to look into it and say, hey, 33-year low in home sales in Greater Vancouver, they're definitely going to begin to be more cautious on their lending as things continue to look worse and worse. So that's really the gist of it. It's just ultimately just an indicator of the market, essentially.
What are bond yields? Are they crashing, and what could it mean?
Yes, we've seen, I believe actually, I think the 5-year Canada bond crashed below 140, so it's down over 100 basis points since peaking in November. It's since recovered now back, I believe today it's around just under 1.6. I think it's around 1.58%. So essentially, if you look at the 5-year bond, it closely tracks the 5-year fixed mortgage rate in Canada. So what you've seen with that 5-year bond yield having plunged over 100 basis points since peaking is the banks have begun to reduce the 5-year fixed borrowing costs. So they've cut mortgage rates by typically by about 20 basis points. That's kind of what we're seeing right now. Do I think they'll give back a little bit more? Potentially, you might see another 10 basis points, maybe 15 basis points here or there. But as of now, it hasn't really provided any sort of stimulative juice to the housing market. And that's part of the things is ultimately, you can only lower interest rates so far before ultimately when you have debt levels where they are, is you basically create sort of like a debt saturation where you can technically lower interest rates even lower, but there's no guarantee that will necessarily be stimulative to the market, because there are also banks, you can lower interest rates, but that doesn't necessarily mean that banks will A, lend you money, and B, doesn't necessarily mean that people have a desire or a willingness to borrow that money. So that's really, it's kind of like the law of diminishing returns and debt saturation. So just because mortgage rates fall 20 or 30 basis points, it should not automatically be construed that it will provide stimulus, particularly given the backdrop that we're facing right now in the Canadian economy and the housing market.
We'll have more with Steve Saretsky when we return.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Steve Saretsky. Steve, as mortgage rates drop, is housing affordability getting better, and are banks loosening credit?
Yeah, that was one of the big contentions that I had a couple of months ago, and I think consensus was that rates would continue to rise unabated. The central bank, the Bank of Canada, would just continue to hike rates, and so basically any sort of decline in home prices would basically be offset by a rise in mortgage costs, which I, at the time, 3 or 4 months ago, I said that wasn't going to be the case, because realistically, the Bank of Canada, they always have an optimistic outlook in terms of how many interest rate hikes they're going to get. They never forecast a recession for obvious reasons. And, you can't simply hike to 2.5%, 3% interest rates, on the backs of record high household indebtedness without something breaking. And that's kind of what we've seen as interest rates now, they got to 1.75% and things really started to fall apart. And so the Bank of Canada has essentially come out and said, we're on hold for now. And markets are basically pricing in greater odds of a Bank of Canada rate cut as opposed to a rate hike. So basically what we've seen, again, as a result, we're not only seeing home prices fall, but we're also seeing mortgage costs start to fall a little bit as well. And that's why we've seen increased affordability all around. And that's even per the RBC's affordability index, you've seen affordability ease up across the nation. And, again, does that necessarily mean that that will increase bank lending? I certainly don't think so. I think that, net interest margins, from a bank lending perspective are being compressed. That's just a disincentive for them to issue more loans, and particularly in a deteriorating housing market, where there's more risk for the banks to take on. It really, again, just curbs an incentive to issue new loans. And, if you look at the February data out of the Bank of Canada, Residential mortgage credit growth continues to fall on a year-over-year basis. And I think now growing at just over 3% year-over-year in February. That's the slowest pace of growth in residential mortgage credit since May of 2001. So we're really not seeing any uptick as of yet.
What kind of loan growth is happening in BC and Canada?
Yeah, so I mean, obviously from a macro perspective, as I discussed, the residential mortgage credit's at a 18-year low. But if you look at like total loans being issued in basically the big six banks and federally regulated institutions, is you're seeing the total mortgages outstanding actually shrink in parts of the economy that are weaker. So you're seeing loan growth on a year-over-year basis actually fall into negative territory. So it's the first time since the late 80s that's happened. And you've seen that fall in Alberta and Saskatchewan, where basically the economy is not quite as strong, and there's obviously a much more negative outlook on future growth there. So you're seeing loan growth shrink. You're also seeing it flatline and likely will head into negative territory here in BC. So as of December 2018, the total mortgage book loans actually only grew by 0.2% year over year. And I suspect that will likely dip into negative territory in 2019 here in BC.
Is increasing housing debt still sustainable?
I mean, it can certainly go higher. I mean, it's not sustainable in the long run. We've seen other economies certainly drag it out to more elevated levels in Canada, such as Australia. But I think that as policymakers, I think have become well aware is that it's clearly not a sustainable growth model. And that's why they brought in policies such as the stress test and to try to bring up interest rates a little bit higher, to really dissuade that. They've changed not only the stress test, but various lending policies inside CMHC, to really just restrict, increasing levels of household indebtedness. You've seen like stress testing on home equity lines of credit, and all that sort of thing. So, it's really not a sustainable model in the long run. Any sort of economic slowdown and or shock, just puts you at a more of a financial stability risk when your levels of household indebtedness are that high. And, trying to derive growth, out of a household that, 100% of your debt to GDP is in a household sector, that it's really hard to derive future spending, when you have that level of indebtedness. And obviously consumer spending makes up roughly 65% of GDP, in Canada. So, there's only so far you can push, household indebtedness and push elevated home prices to derive that growth, before it really just becomes like you're pushing on a string. And I think that's kind of where it's reached a point in Canada, and that's why you've seen an obvious pivot from policymakers, we're going more towards the public fiscal side of spending, and that seems to be the likely route is likely future growth, and Bank of Canada's talked about this quite a bit. If you go and read the reports, that future growth is likely to be derived through a lower devalued currency, and through export growth here in Canada, as if the household sector is clearly rolling over, and so you can't derive future growth out of the household sector. You have to derive it out of exports, which likely means a weaker loonie.
Steve, thank you so much for chatting with us.
Always a pleasure. Thanks a lot, Jim.
My guest has been Steve Saretsky. He's a Vancouver-based realtor. You can find him online at stevesaretsky.com. There's nothing wrong with your computer. It's my voice, folks, so please hang in with us. If you have any questions for Steve or any of our other guests, please email us at info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.